Hey everyone, you know who this is, right? Quite a busy week, quite eventful, especially those following CarMax. Um, it's not sorcery, there are no crystal balls, I promise you that. Um, I'm making this short video today. It's Sunday early morning in Dubai, probably 5:36 in the morning. Um, just to address some recurrent themes that have come along based on the responses from you guys. From the two videos I've put on YouTube, and it's to do with the topic of how do you identify a price target slash how do you come up with the fair value of a company's share price. Why is the share price moving so much? Why do you have an outsized move uh, on earnings day? What's actually driving all of that, right? So I wanted to just address this, and I'll try to be as brief as possible. Um, so let's take the example of CarMax, right? We are on the 4th of January 2023, which is when everyone gets back to the office. The analysts and the fund managers are looking at CarMax and they're saying it's currently trading at 60, and everything is just for argument's sake, right? It's currently trading at 60. We would allocate a price target of 20, or the market is already allocating a price target of 20. We believe that's correct. We'll go with that. Based on our analysis for the next 4 quarters, we believe that CarMax will actually make $6 per share in profits. So you're looking 12 months in advance. So 6 times 20, that's $120 per share. So if that thesis is true, then they believe that CarMax should be trading at 120, but today is trading at 60. So these guys get together and they say, fine, we'll start buying CarMax. Let's put a $20 million position into the portfolio. The traders get busy. They start buying CarMax. Let's say anywhere between 60 to 70, they are buyers of CarMax, because it will take a couple of days, maybe weeks to fill in that position, right? So every day the trader is in the market buying CarMax at like 60, 60.5, 59, 58, 55. And he's a buyer as long as his position of 20 million is fully put into the portfolio. The whole basis of doing that is because he thinks he can sell it at 120 in 12 months time, right? So every week that goes along, you'll have new information that comes out in the form of macroeconomic news. So that those would be inflation numbers, GDP numbers, consumer sentiment numbers, interest rates, and all of these things. Some of them will be relevant to the thesis on CarMax. Some of them not necessarily so. You'll also have industry-specific news on especially used car values, a lot of things related to lending and how is it getting more affordable, less affordable, cheaper, costlier to borrow. What's happening on the consumer end? Is demand increasing, and so on and so forth, right? So every day, every week, the analysts would get together and revise their thesis. Basically, they'll assess all the incoming information with respect to whatever was assumed in their original thesis, and work out whether the uh, the probability of CarMax trading at 120 is still high, or if the thesis is getting even better. At the end of the day, they have assumptions on the basis of which they've assumed that the next 4 quarters, CarMax will yield $6 per share in profit. So this game carries on every week, month, and you have at the end of the quarter, you have the first quarter's earnings. The company will release actual financials that that is actually you know for the company itself. So now you're looking at real information for the company, and you can actually use that number and a lot of KPIs that the company will give out in terms of how well it's doing. quite a few insightful management commentary about how they are perceiving their particular industry and how they think the outlook will be for the next 12 months or next 6 months or whatever. So every quarter there's a lot of information that comes in. The analysts get together and they assess, or they take all that information, distill it, synthesize it, and eventually they go back to the original thesis to say, to try to answer this particular question. Is it still likely that CarMax will trade at 120 in 12 months time, or now it's like in 9 months time? So if the answer to that is yes, they do nothing to the portfolio. They might even add to the portfolio depending on, if they have a brighter outlook on CarMax. Now they think it's going to get to 150, 200 or whatever. They might say, we could add another 10 million, 20 million based on the portfolio and other portfolio risk management metrics. However, let's say the first quarter results are out. Let's take an example. Interest rates are through the roof. Management is saying it's getting very difficult to actually seal deals with the consumers. Consumers are not able to finance their cars. And this is actually throwing a significant spanner into the works for the whole company. And they believe it's going to get worse in the next 2-3 quarters. So now analysts have a piece of information which is extremely insightful, and they can use that and just go back to their thesis and ask themselves, is it still likely that the company will earn $6 per share in the next 12 months, right? So already one quarter is over. So they will have an idea of what the earnings per share for that quarter was. This is actual versus their expectation of earnings. So on Wall Street, all the analysts come out with their own numbers, and there's kind of a consensus number that gets thrown out based on the average of all the analysts, right? So this is literally what you see as estimated EPS going into earnings, right? And you'd have the same for revenue and other metrics. So basically what will happen is, let's say there's a significant thing that has happened in that quarter that analysts had not factored into their original model. So now if the analysts get together and they say, you know what, earnings was not that great, the management commentary was not great, the outlook is poor, we think that original thesis of $6 per share is probably too ambitious. We believe it will only be able to manage, let's say, $4 per share. And we believe it can still trade at a 20 times multiple. So 20 times 4, now you have a price target of 80, right? So the original price target was 120, now it's 80. Let's assume over that period the share is trading at 70 now, right? So now the fund managers will look at this situation and say, look, you're saying it could earn $4 per share. I'm seeing significant headwinds. Management is uncertain about many factors. Even that $80, I think that's kind of a best case scenario. So maybe if I look at the bear case scenario, we could get to $2 per share. So that means 2 times 20, that gets CarMax to $40 per share, which is a bit of a problem for us because our entry price is around 60, 65. And if it gets to 40, then we're making a significant loss. So they'll all discuss and eventually come to a consensus. And they might decide that having $20 million of CarMax in the portfolio at an average price of 60 just doesn't make any sense, because the prospect for the company or the share price over the next 9 months is no longer the same. And this is based on actual numbers that are coming out, actual dynamics that are happening in the market. So that expectation from January get revised downwards, and on that basis the fund managers ask the trader to perform some actions. In this case, he is very likely to tell the trader to start selling. So start selling every share of CarMax because we don't believe that the thesis is going to work. It's been invalidated. So now you've got supply of $20 million of CarMax shares that's coming to the market. Of course, it's not going to go in one day. They will be sellers for maybe a couple of weeks. It all depends on the urgency, you know. If the fund manager says, I don't want to see CarMax in the portfolio, just liquidate that at any price, then you're going to have a big problem, because that guy is just going to be selling aggressively into the market. And keep in mind, that's not the only fund that has figured this out. Every single fund that owns CarMax will be sellers, either full position or partial position. They'll start lightening up on the position. Eventually what's happening is all the guys who were shareholders of CarMax are now becoming sellers, and the guys who are on the other side, they are not stupid, right? They are buyers. They are not buying at indiscriminate prices. They've done their homework. They also know that CarMax is having issues, industry-specific issues, and that they probably will only buy it at 40. They'll, similar to how in January you had the guy say, okay, between 60 to 65, just keep buying until we get $20 million position into the portfolio. Now you have new marginal buyers who are going to say, we do think CarMax is a buying opportunity, but not at this price, because there's no significant upside, and there's a lot of risk because management themselves don't know what's going to happen over the next 3 quarters. So we'll only start buying CarMax at 35, 40, because they also want a margin of safety. They're not going to buy and hope for the best. That's not how it works. So basically what happens is you have guys who have an average entry price of 60. You have marginal buyers who are like, okay, we'll only buy from 40 to 45. So you need to have an equilibrium between these two stakeholders, right? And these would be major sellers, major buyers of the stock. And in between, you'll have traders, you'll have, the whole ecosystem that's, kind of buying, selling the share every day. But literally, what drives these stock prices is these big stakeholders, these big fund managers that are in the market for days, buying and selling the share. And when the new information comes out, and everyone is on the same level of information, right? They might have different views of what the price target might be. They might have different scenarios in their heads, but it's very rare that you'll have a guy who thinks it's going to 200 and another guy thinking it's going to go to $10, right? Because only one of them will be right. And if you have this kind of wide disparity, it also means that there's so much uncertainty into the economy, the industry, the company, that no one can literally figure out how the whole machine works and come out with a number with certainty, right? So essentially what I'm trying to showcase here is what will actually move the price. It's very important to understand that with equity markets, it's all about the marginal buyers and sellers. So the share price today, it means nothing tomorrow, right? Let's say I've been buying the stock at 60. Tomorrow with new information, it means nothing that I bought the stock at 60. The stock doesn't care. The market doesn't care that I have a position at 60. The market only cares about the future. And every time you have new information, the market will revise its own expectations and allocate capital on that basis, right? So it's all down to the next buyer and the next seller. Where do they agree the share price should trade? And their decision will be eventually based on the new information that's coming out into the market. So this is how you have big price movements, big price dislocations. And your job as a trader is to anticipate this, be positioned for it, and when it's happening, just keep your head on your shoulders. Don't panic. Don't start doing things that are not portfolio friendly. Just make sure you've got a calm head. You know what you're doing. You know what's actually happening. And if there's a liquidation event, just make sure you participate and you are actually growing your PNL on that basis. So don't get too excited. Don't increase your risk. Don't do things that are just plain stupid. It's not gambling. There is a lot of method behind it. It it is not sorcery. I'll tell you that again. It's not coming out from a crystal ball. We're not shooting from the hips. This is all this is this is all a little bit of an art. It's not a science. It's a little bit of an art, right? So you have to understand human psychology. You have to understand what every stakeholder is doing, and also anticipate what the marginal buyer and seller will be doing if certain scenarios play out in the market. By scenarios, I mean, what if the consumer sentiment number is bad or really good? What if the Fed cuts interest rates tomorrow? What if used car values just plummet 10, 20, 30%? How is that going to impact expectations in the market? One thing that's very, very important to understand is that money in the market gets allocated on a 6 to 12 to 18 month basis. That's the majority of the money. These funds are positioned on these time horizons. And it's literally, like I explained to you, based on these targets that they've got at the start of the trade. And as you go along, you get information that comes out. Then these expectations get revised upwards, downwards, and that's actually what will move the stock price based on what the marginal buyer and seller think about the stock, based on all the information that's now public, based on what management is saying, based on the numbers of the company, based on numbers from peers of the company, basically trying to incorporate every piece of information together to build that picture, to understand very firmly and very convincingly what the earnings picture look like over the next 12 months, 18 months. So yeah, this is it from me, guys. I hope it was useful. I'll explain this a little bit more in detail, I think a bit more comprehensively for a broader audience, and put it on YouTube as well at some point, so people can get their head around this and understand really what drives equity prices. It's not the position of the sun, moon, Jupiter, none of that nonsense. It's not what's written in the newspapers, not what every guy on CNBC is saying and so on. It's just irrelevant. Literally, what I just told you is actually what happens for every single share in the world. Every time a share is moving, it's because someone is buying and selling it, and expectations have shifted, whether it's upwards or downwards, right? Okay, cool. Thanks, guys. It was not that short, actually. 19 minutes.